For 13 years, I managed Fidelity Magellan Fund. Those were 13 amazing years. 9 times the market declined by 10% or more, and I was very consistent. All 9 times Magellan Fund fell 10% or more. I learned a lot of lessons. I think they're true now. I think they were true 20 years ago. I think they'll be true 20 years from now. I think I can help you do a better job of investing.
You can't learn years of stock picking experience in one night, but you have better stock picking skills than you realize, and you have advantages that no one on Wall Street has. In Stock Shop, I'm here to help you find them and use them. You may be wondering why stocks are so important for a long-term investment program. The short answer, over time, stocks produce better returns than other investments. The past 60 years, stocks have returned about 10% a year. Bonds have averaged 6% a year, Treasury bills or bank CDs around 3%. That doesn't seem like a big difference, does it? But the power of compounding makes an enormous difference over time. Suppose you invest $50 a month and earn 6%. After 30 years, you have over $50,000. Go ahead and play with the numbers yourself.
If you clicked on the Assumptions button on the previous interactive screens, you noticed that the worksheets do not take taxes into account. When your investment is taxed, the government reduces your return every year. If you know you won't need the money until retirement, you should place as much of your investments as possible because you don't pay taxes on the money until it is withdrawn from the accounts. The power of compounding achieves the maximum effect, providing you the best return possible.
The more time you have to let your earnings compound, the better results you'll get. A 20-year-old who invests $200 a month and earns 10% on his money all along will have $1.1 million by the time he was 60. A 35-year-old would have to invest $800 a month to have the same $1.1 million at age 60. You're going to have a tough time getting that 10% return without at least some stocks in your portfolio. Before you start to invest, ask yourself one question. When will I need to use this money? The stock market is a long-term investment. If you need to use the money anytime soon, you should not invest in stocks.
This is money you're willing to put in the market and leave it there for 5, 10, 20, 30 years. That's the kind of money you can do well with. If you're worried about it, don't invest it. The stock market is volatile. Individual stocks are volatile. The average range for a stock in a year is 50% between its high and its low. Stocks go up and down. The market goes up and down. If you're investing with a 1 or 2 year time horizon, you shouldn't be in individual stocks, you shouldn't be in equity mutual funds. If you've been lucky enough to save up lots of money to send your children to college and they're starting school in 2 years, what are you going to do if the market goes down?
In the long term, 10, 15, 20 years or more, stocks have beaten bonds and banks' certificates of deposits. But in the short term, there's no telling what will happen. In 1987, the S&P 500 fell 33% from its August top to its October bottom. If you had the stomach to ride through that drop, you would have found that the S&P performance from 1987 through 1992 still outperformed Treasury bills and long-term government bonds, despite that decline. If you want to double your money quickly and safely, fold it in half and put it in your wallet. Any other way, you're simply gambling. A good stock can take 2, 3, even 5 years before it really pays off. It's not 2 or 3 weeks. It's not 2 or 3 months. My best stocks have been in my 5th, 6th, 7th year. Give your investments time to grow.
Many people ask me, when is the right time to sell a stock? Selling stocks is a matter of comparing stories. If story A is better than story B, then sell B and buy more A. If you own 8 companies, you're playing 8 simultaneous games of poker. So only stay in the games that you have the best chance of success. But remember that stories rarely change overnight. It may take years for a good one to be recognized by the market. Give your good stories the time to grow.
Your advantage in picking stocks is your direct experience with companies as a consumer, on your job as a professional, or as a neighbor. Use those advantages as a place to start looking for good stocks.
You have several things that you possess that will make you a good investor. They're inherent to your life. It's the field you work in. It's the area where you live. There may be some local company that's terrific. You're a consumer. You see some products. You see some services that are terrific. We bought a Volvo. It was better than the American station wagons. It was safer. The price was right. I did a little bit of research. I found that Volvo, the stock, it's a Swedish company, was selling equal to its cash. You're paying almost nothing for the company. They had lots of other divisions that were doing terrific.
Buying that card turned out to be a great way to begin researching the stock.
Sometimes people take things for granted. My field was the mutual fund industry. In the early 1970s, the industry grew slowly, but then it took off in the 80s. Money piled in to money market funds, to equity funds. Investing is a personal thing. You have to do it by yourself. You don't do it with a committee. You have to be able to have the emotional strength to stand the volatility of the market in general and stocks in general. If the key organ here is not the brain, it's the stomach. Do you have the stomach for this? Do you have the patience for it? You should be able to look in the mirror and say to myself, what am I going to do if the market goes down?
If you know something that will drive a company's earnings higher, you know something that will drive the company's stock higher, sooner or later. But you can't just guess at it. You have to have some reasons, such as costs are coming down, or new products going to be a big hit. Research is developing a company story, an idea of why earnings should go up or down.
Research is exciting. It's very little math.
Research starts with the things you know, your edge. If you're a mechanic, look at the tools you use. Which are the best? Which are the best value? Or if you're a doctor, see what new technology saves the insurer money, or software systems that reduce costs at hospitals. You probably already know a few companies quite thoroughly.
The amateur investor probably can follow between 5 and 8 companies. They could lecture in these 5 or 8 companies. They know them very well. There's 10 to 15,000 public companies in the United States. There's lots more overseas. So you don't have to be experts on lots of companies. You just have to know a few very well. It's a lot of fun. It only takes a few hours a month. It's not a full-time job.
Actual bad economic news, rising interest rates, wars, elections, any of these can push the market down. If you're one of those people that pore over graphs, economic statistics, or astrology charts, trying to figure out what the stock market is going to do next, you are wasting your time. No one can predict the market.
You have to understand the market goes down. There's been 95 years this century. We've had 50 declines of over 10%. Of those 50 declines, 15 have been 25% or more. So about once every 2 years, the market falls 10%. About once every 6 years, it falls 25%. These are big drops. You have to understand that. That's the nature of the market. In 1990, Saddam Hussein went into Kuwait. The banking system was in trouble. We had a recession. You had all this background noise. The market fell from 3,000, it fell over 20%. This gave you a great opportunity to buy terrific companies at very good prices. Behind every stock is a company. If the company does terrific over a long period of time, the stock will do terrific. If the company does lousy, the stock's going to do lousy. That's all you're betting on.